This group is for those who do not believe we were put on this earth to work for 40 to 50 years to hopefully retire at 65 and be well off. But for those that believe we were meant to do more, meant to be able to control our day to day and be able to retire early and truly start to cross those items off the bucket list while we can still enjoy it. I had a conversation with somebody earlier this week, and they were trying to figure out how they can develop a long-term strategy for building financial wealth and really just financial wellness. And it wasn't necessarily real estate related. As you know, I love talking about real estate all day, every day. I am a realtor, but this was more around just overall financial health. And the tip that I was able to give them, and it's one that I use to this day, is just know where your dollars are going. And if you can take a look at where your dollars are going, be intentional about it and set a percentage value to where each dollar should go. And what I mean by that is, well before I was making six figures, right? Like years and years ago, when I was just making a couple $100s, things of that nature, I figured out, okay, what are my expenses a month for rent? And back when I lived in Philly, I used to pay like $375 a month for rent to live with, other people, right? When I was in college. And so at that time, I was like, okay, so $375 is my rent. This is how much I'm bringing in on a monthly basis. And so X percent is allocated to rent. And I set in my mind at that time that, hey, I don't want to be paying more than 25% of what I'm making on a monthly basis toward rent. And so as I continue to increase and start to actually make money with my W-2, with investments and ventures, I just kept to that motto. So when I went to making, hey, now you're making $60K a year, I was like, all right, I don't want to spend more than 25% of that on what I'm staying in or living in. And so 15K divided by 12 is what I would spend on a monthly basis. Now, it doesn't mean that my mortgage or my rent wasn't higher. It just meant that I had to find a creative way to make it so that my out of pocket was going to be that 25% or less. It works the same way when you think about savings, right? If currently today you're saving X amount, let's break that down into a percentage, try to automate as many of those savings as you can. And then as you continue to increase, when you get raises from work and things of that nature, you can just keep plugging into different savings, plugging into different investments, and it makes it a little bit easier. The hardest piece with this is being intentional and actually sitting down and writing it down and thinking through it. But believe me, if you take the time to think through this and write down kind of where your money's going and where you want it to go and what percent is going which way, it will start to increase and it will start to allow you to have some more flexibility and some more financial freedom. But I will hop off of my soapbox. That was kind of a big thing for me today. I was thinking about, I was like, man, this is something that's super important. But this is an open session. Please, if you are on the computer, go ahead and join. And we'd be happy to have you in. And I see my guy, Dom, is on. And yeah, tonight is really just an open session to talk about kind of whatever. So this past time, even with the bank failures, they still went up a quarter point. I think they're going to do, in my opinion, one more quarter point and then kind of chill out and just let it sit there, which in all reality should keep interest rates right around where they are today, because the spread between interest rates and the bond yield actually got bigger than historical norms because the banks were nervous that the Fed was going to keep going up at a crazy rate. But now that they settled down, they'll be able to actually kind of compress that and keep it to normal rates, which will keep us right around where we are today, if that makes any sense. And so I think the rates are going to stay similar to where we are today through maybe toward the end of the year when it gets down to that slowdown season, where historically there's less buyers, in the wintertime and things of that nature. And then at that point, it'll hopefully start to drift back toward 5%. And if it does, it's going to be a grand opportunity to start refinancing some of these properties that we bought at the 6.25, 6.5. I have some clients that bought at 7.5. But the thing about the higher interest rates is it did take a lot of the buyers out of the market, and it allowed for more negotiation and to be able to property, right, and kind of get more value in that property and then refinance it. And now it's just an even better deal, if that makes any sense. Oh yeah. What are your thoughts? Because I know you've been researching this too. What do you think is going to happen?
Oh man, that makes a ton of sense. I got you. I think what you said is probably spot on, man. I do think on some level, one of two things is going to happen. Either A, it's going to start drifting back down to 5, or basically everyone's just eventually going to get tired of waiting and just jump back into the market. And at that point, we have no idea what next is going to happen.
these homes are getting snatched up quickly and they're still very desirable, and it's going over asking, both on the sell side and on the buy side. And so between bigger pockets and millennials just being more, able to Google stuff and kind of understand like, hey, how can I save money on stuff? These are desirable assets. If you can get some of these, dude, the value of these are going up rapidly, right? I'll just put it at that. And so for my next couple properties, that's all I'm really looking for. If I can get, something that has a full basement where I can add a kitchenette, add like a separate entrance, things of that nature, or if I can get, a small multi, even though they changed up the lending for it, so now it's harder. That's the pieces that I'm looking for because people are seeing a lot of value. And also when you look at just being able to own some of these assets right now, one thing that you mentioned, Dom, is the fact that people are just getting tired of waiting. Like a lot of people on this call are within that millennial generation, right? Or just on the cusp of that millennial generation. And this is the largest group of buyers that we have today. And most of the millennials went through '08 seeing their parents and, close family and things of that nature go through turmoil with real estate. And so they delayed their time into real estate, but now they're starting to start families and getting into that prime buying age. And so there's only so long before the dam breaks and people start buying all these houses. And so I look at that and I'm like, hey, I'm going to acquire as many as I can because these values are going to continue to go up as more millennials are looking to move into a city like this and kind of purchase homes. A brief update for everybody. We've officially started the storage project and broke ground earlier this week. I got some videos that I need to edit and stuff, but my realtor out there, who's my business partner, actually went out to the land and was just filming the bulldozers going left and right. So I'm like, hey, this is cool. Something's happening with this money that we invested in. This is good to see. And we kicked off the syndicate for the townhomes. So it's officially going to start taking investment on Monday, but I've actually already had first investor meeting on Monday and kind of sent out the deck, and we're kind of fine tuning and answering additional questions around like, hey, what are some of the tax benefits? What does that look like? Things of that nature. But super excited for those two projects. And that's where a lot of the focus is going right now too. And to that point, and Radim, I love that approach because it's different. You're right. You're more buckling down on the portfolio that you've built over the years. And so I got a couple questions for you. When you talk about your properties, right? So most of your properties, please correct me if I'm wrong, you have more equity than loan on them, right? Like it's mostly paid off, most of the properties right now. Nice. Well, that's where we hope to all be at some point. But I love the strategy of, hey, instead of increasing the rent for one person, splitting up the units and renting out kind of by the room, things of that nature. My only question is, from a management standpoint, has it gotten more intensive, and how are you handling, like, do the people know each other, or is it different? Like, hey, you got this room, you get this room. And what you mentioned is, I mean, for those that are humble enough and willing to take that step to say, hey, I need to save some money, stop spending all of it on housing, and maybe I need to take on a roommate, it's a great option. I can tell you that when I moved up to Boston, I was there for 3 years. For 3.5 years, 2 of those years I actually had 2 roommates. And then the last year and a half, I had 1 roommate. Reason being, the regular house hack didn't work because it cost $800,000 for a duplex fixer upper, right? And I'm like, hey man, this ain't gonna work. Boston's one of the top 5 most expensive markets in the U.S. It's right there below like Honolulu and Manhattan, believe it or not. And so, long story short, I did exactly what you're talking about. I rented out a couple rooms. I think I was paying $1,500 a month to have 2 roommates, right? And the mortgage was like, I don't know, $3,600. So it's like, okay, but it's worth it, and it can help you get to that next step and save and save and save. And I see we got Desmond with the fresh tan from overseas, man. How you feeling? Welcome back.
What's up, man? I'm feeling good, dude. I'm feeling good. Yeah, man, thanks. It's been a minute. I've been working out in the evening, so I was shaking a little bit, right?
Okay,
but
so how's it?
It all went smooth. Yeah, I got Turnified coming. I bumped my cleaning fee. It started way down at 30. Now it's up to 80. And I've noticed I'm getting fewer bookings, right? I've noticed that it hasn't been enough for me to like definitely say, right? It's like for absolute certainty, right? But it seems like over the past, like, I think it's been like this for 3 or 4 weeks now. It's kind of slowed down a little bit, but I mean, I don't think it's going to be a huge deal. I think especially with the 2 units, I can kind of take that. I can take a little bit of slowdown, and I think I'm going to play with the price a little bit. I think my occupancy was getting to the point where I was just raising the price to see where, how high it could go. But I think now that the cleaning fees are a bit higher, I might have to come down a bit on the price, like literally yesterday. You know what I'm saying? How can I start moving into the next one? And even before I do my next purchase in the fall, right, which is when in October I'll be able to kind of get out of my FHA lease, right, and move somewhere else. And that's definitely the goal. And I want to move into another house hack, most likely a duplex. If I can stretch a triplex, we'll see. Say I got 7 units on my belt, we'll see. But I definitely at least want to do the duplex. But I want, even before that, to play around a little bit with Airbnb arbitrage. And it's funny you mentioned rental arbitrage just a minute ago. So I want to play around with that, because now that I have the operations in place, right, I've got Hospitable set up. I know how to use it, right? I've got Turnify coming in. That's going to take a huge weight off my back. I'm like, man, like the hardest thing is the setup. You know what I mean? And I think we had talked about that a little bit too. When you during the management, that's kind of like one of the biggest pieces, right? So if I could set something up, right, with a 0% APR card, pay that back within 3-4 months. Even, the terms on those be like 12 to 15 months, right?
We actually have 2 of the deals under contract right now where the previous owner, or the current owner, I guess, was working with different rental arbitrage companies, right? Where they signed like a 2-3 year lease, they furnished it, and they're going to move all that stuff out before closing. But they were doing it. They were doing it well. They just paid the owner X amount. Typically, owners are going to want a little bit more than like the regular rental rate. So I'd recommend like maybe running the numbers on, hey, here goes the average rent, or what do you get for rent, and maybe going slightly over. But if you can make the numbers work, and you can get the furniture for a little bit less and are okay kind of moving it, dude, this strategy can work.
Right. And that's what I'm thinking too, right? Like, and I don't even want to go in initially. Like, I might be willing to budge on like paying a little bit extra, but I was listening to a guy who does like one of those Instagram ads that pop up. Oh, hey, do you want to learn about my business? Right. But it was actually interesting because he was saying like he has the same sort of business. They do it through LLC, but he doesn't pose it as like the landlord's doing a benefit for them. They kind of pose it as, hey, we're doing a good benefit for you, where like we're paying the rent consistently, right? We're keeping the unit super, super clean, right? You know exactly what we're doing. We'll handle the maintenance, right? So I want to kind of, if I can, pose it as like, hey, like I'm doing you a favor, you know what I mean? So like I don't want you to think I'm going to be paying extra, or you're going to be getting a cut of the profit or something crazy like that, right? I want to pose it as like, hey, you be favorable to me because I'm the best tenant you could have.
It's a great model, and a lot of people, if you pitch it in that way, should be able to go for it. But the reason I talk about the management versus the arbitrage is let's just look at the dollar involvement with it, right? So you mentioned the systems is the hardest part. That truly is. Like, hey, how do we even get this place furnished? Right. How do we get this thing listed? You figured out the booking.com. I still have no idea. I just go to you. I'm like, hey, man, I still got to send you 2 more. It's been like 3 weeks, dude. I got the green light. I'll send that to you. But long story short, the arbitrage, you do have to put some money up front, right? You're going to have to put X amount to the owner for a security deposit and first month, and then you got to take the time to kind of get it up and running. So that's some money out of pocket. Then you've got to furnish the place because they're most likely not going to furnish it for you. So that's some money out of pocket. And so it really is going to take you a little bit of time to recoup those funds and then start making money. The reason I don't mind doing that on a property I own is because we control the terms. I'm going to have that property for a long time. I'm writing all this furniture off, and now I'm getting the equity. And so it makes it completely worth it. I'm like, hey, let's do this thing. I can switch it over. There's a lot you can do. On an arbitrage, you get a little bit nervous about that because the owner controls that piece. But to talk to you about the management piece, you're right. You only make money when the owner makes money. So you're directly aligned. When you think about it, you were nervous about this short-term rental thing in the beginning. When have you seen 0 bookings in a month? You're always going to get something, and you know that this is actual income because if there's anything that breaks, this is getting billed back to the owner, not you sending your maintenance guy out, and now your cash flow is gone for that month. Does that make any sense? Say you make $500 as an arbitrage, right? But I don't know, the guest does something, breaks some furniture, and you go and get like half of it covered, and now you got to pay the rest, right? That's money coming out of your pocket. Whereas for the management company, yes, we're going to go after the guest. We're going to try and recoup that money for the owner. And we have different ways of doing that now with auto host and kind of security deposits. But at the end of the day, it's getting billed back to the owner. We're just taking our fee off the top. So it's a little more consistent. Like I can say on average, even from like smaller units to bigger units, on average, we should make about $500 per month per unit. Now, there's going to be some bigger ones, like the mansion's going to be way more than that. But on average, it should be roughly that for like a 3-2 or, 4-bedroom, things of that nature.
No, for sure. Right. No, that totally makes sense. That totally makes sense. And I want to keep that in mind too. And I might end up, and it's very likely I might end up doing both. You know what I mean? Because I have an LLC that I just opened up. It was really going to be something unrelated, but then this arbitrage thing, I've heard it more and more, and it's like I'm getting these Instagram ads. They're getting better with the targeting, so I'm like, oh man, like I could do this, right? But yeah, I want to play with that, and specifically, I want to play with like using other people's money and at least not using my money, right? So like, can I get some sort of business credit or business cash, right? I need to get more savvy with utilizing an LLC and, not using my own money basically, but I want to try to see, can I in some way get a very low interest loan to pay and maybe loan's not the right word, right? But some way can I use someone else's money to get for that capital that I need, for that hard cash to actually pay the rent, pay the security deposit. Because that's really what you need the cash for. Like the landlord's not going to take. I mean, most landlords are going to take like credit card, right? So that's what you need actual cash for. But in terms of like the furniture piece, I'd be comfortable with having a credit card, ideally under the LLC's name, but if needed under my name, 0%. Right.
I can tell you for the last LLC I opened up, which was not the last one, but the last one I bought an Airbnb in last year, they were able to give me like $30K in credit just because the strength of our relationship from LLC in Louisville and all this other stuff. They're like, okay, it's the same person. They're still going to run your personal, right? But it's fully on the LLC. Like it's not going to show up on your credit report or anything like that, which is, and Kareem can speak more to business credit probably than me with the Amazon business.
Yeah, that's right. They do run it. They run you as a guarantor, basically, and then you get approved under the LLC. It does not show up.
You better be making those calls. So, like literally, for the storage unit, my realtor and I, we signed on for $2 million, right? So we're getting this thing built quickly, and we got to get this thing rented out quickly because the bank's going to come knocking here soon. That's one. And then for the townhome project, because we're going to be the general partners, they're looking at all our assets, right? And we're signing on as guarantors there. So it's one of those things where until you can get to like the super high levels where you've done like a bunch with the same bank, that's the time where they'll let you do like non-recourse and hey, it's not tied to you. But early on, when you start to move into bigger territory, it's pretty much all going to be, hey, you got to sign guarantor. But one piece that you mentioned earlier, I know Dom's done some research on it and actually had maybe a couple opportunities, but you were talking about the arbitrage versus rental. Dom, I know you looked into the arbitrage model a bit. What are your thoughts there? Any notes for Desmond?
A good way to start is with the business credit card. That's what I was looking to do myself. Because to tie into what Niyi was saying, you don't control the terms. So you got to make sure everything's in that contract, in that, that lease that you sign. You have to make sure it's like guaranteed in there because they could sell that property, they can choose not to renew, whatever. You have to have that in the back of your mind of, okay, what if this happens? And don't get me wrong, it's a fantastic model, but it's just one of those things where you have to be like, anticipate that next step that could come your way because you don't have control. But like let's say you sign like a 3-year lease with somebody, you'll make a ton of money. It's like, okay, great. Where can I use this money? So I think it's a great starting point for a lot of people. Arbitrage is like a general thing. I don't know what your portfolio looks like or anything like that. I think it's a great strategy to start, get yourself cash flow, then to go buy more property, use it as like an engine to fuel.
That's exactly what I
property.
want to do. Like I'm not trying to quit my job with this, but if I could make a little bit extra money, right? 500 would be great. 1,000 would be awesome, right? A month, right? From something that doesn't even really require a lot of my own money, or even in something where like I know I'm going to be getting the money back, and like to say I know it is a strong word, but like based off how my current ones are going, right? And Dom, you said you don't know my portfolio. I have 2 B&Bs and they're in a 4-plex, where I have another long-term tenant as well. Based off how those are going, I can.
That costs $1 million first off. Yeah.
Like, if I do it in this area, right? Same model of the apartments, just the 1-1. then I should be able to make that money back. And that's exactly what I want to do. I don't want to go like, I'm in College Park, so I don't want to go buy a B&B in Buckhead that's 4-bed, 3 bath. Like, that's not my territory right now, right? Yeah, exactly. And even the rent on that would be like $4K. So I want to get something like reasonable, like in my ballpark, like maybe even like find a niche in like airport B&Bs, right? Who knows? So yeah, I want to like do it ideally like on the same street, or like in like right in this same vicinity, 1 bed, 1 bath, just like I'm decorated just like the ones I have now. Nothing really is going to change too much. And see, yeah, I mean, the biggest thing though is I don't really want to put my hard-earned money cash-wise into the deal. So I'm going to be looking for ways. I used the 401k loan to close on the fourplex, so I'm still paying back that loan, so I couldn't do another 401k loan. But something like that, right, where I could use at least not like current cash in my bank account. So we'll see.
That's the question. At the end of the day, even if you start with one, you could just like, I don't mean this the way it's going to sound, but what's going to happen
Right.
if it fails?
Initially, last March, they were trying to release guidelines saying, hey, you can only have a short-term rental if you're an owner-occupant and that you live in the city of Atlanta. And it's similar to saying like, hey, if you don't live in Atlanta, you can't have a long-term rental, right? It's kind of foolish. And it runs into some legal concerns of, hey, are you allowed to do that? Can you limit commerce between the states? Which is a no, right? And so they just updated it, at least proposed update, and they've crossed it out on the site. And you could look at this to say, hey, you no longer have to live in Atlanta to own one, but you do got to get a license, which is fair. And now they're trying to do what I've seen other cities pass successfully. Like in Louisville, for example, I actually wanted to turn one into a short-term rental, but they have a regulation in there that's been there for a while where if there's one short-term rental, you can't have another one within 500 feet. And 500 feet is a lot bigger than you would think. That's like that's a whole square block almost, right? 500 feet. And so it makes it a little difficult. They got like a heat map. It's pretty intelligent. You can type an address in and say, hey, can I make this short-term rental? And it'll tell you flat out no. And so Atlanta, what they proposed is that one for every 2,000 feet, which is nuts, right? That's like one in dang near a neighborhood, but with one caveat. Those, once they officially pass this, and they're still working through it, those that already have one up and running and are quote unquote licensed would be grandfathered in. And so when I see these things, that's why I'm like, hey, let's rush, get these taxes done. I need to go get another one in the city of Atlanta, get it licensed, right? Because they're still at least 45 days away, minimum. Because they said whenever they release it officially, they're going to give another 45 days for people to go and kind of get licensed, things of that nature, and then you're grandfathered in. So I'm trying to, like, that's a huge development. And it could limit the number of competition you have and kind of eliminate a lot of other B&B people trying to get started. So they didn't say number. They didn't put a number on it anymore, right? All they said was, because before it was supposed to be maximum 2 and you had to live in the city. Now they were just saying, okay, we're going to limit the number in the total city. There's still arguments around that 2,000 thing. They're like, hey,
doesn't
maybe
it
we should
limit
make it a
you
percentage
too, like
of the
in
rentals that are
scalability?
available in the city. Like, hey, 13%, 15%. That's still going to get worked out. But the main takeaway I got is, hey, if you already have some up and running, you can get grandfathered in if you get it licensed and kind of keep going from there.
And the good thing is for people who live in Atlanta and know the area, anyone who sees that is gonna be like, well, no, I'm not gonna invest in Atlanta because they have this strict regulation, and it's gonna push everyone out. It's gonna drive fear in investors.
I think they will pass something. They kind of have to, and I'm A-okay with that as long as we're able to kind of make it through, get our properties approved, and keep going from there. And once you get approved, the renewal process was easy. They literally said, hey, here goes the document. Take it to a notary, sign it, say that, yes, you want to continue for a year, and then just email it over, and it was good. But guys, we are coming up on time. Is there anything else that's top of mind? Dwayne, we haven't heard from you in a while, man. Anything top of mind for you or anybody else?
For me, I heard you guys say, like, whenever you, like Desmond, for example, he was saying, like, once your FHA finishes, you get another one. Is it just a year that you get to reapply for FHA for another one for a different property? But at what point do they, like, look at you, like, you could do it like
Yes,
1 year,
1 year.
1 year. At what point do they kind of pump the brakes on you because maybe they feel as if maybe your debt to income ratio might be too high for this? Or do they, like, is there something that will give them pause even after you make your 1 year to move out and then get another one?
Yeah, so in terms of the year, it's not a year that you have to wait to be able to apply for another FHA, because I think you can only have one FHA at a time. And there's some caveats to that. I think you can move maybe 100 miles, and there's some weird things you could do. But for the most part, you can only have one FHA at a time. And then after a year of, starting your loan, can you move out of your current house and then, move somewhere else? But at least
And
for the first
piggybacking,
year, of getting your FHA, you have to live in your house. So that's kind of the, stipulation there.
exactly what he's talking about is that if you are willing to move once a year and you're going to quote unquote buy another primary residence, the bank looks at that and says, hey, you're going to live here, so you're most likely going to pay the mortgage. So they'll let you put down 5% or less, which is a win. FHA is amazing because you can get up to a 4-unit with 3.5% down, which is crazy. Conventional has changed over the years, and now they've really made it difficult. The duplex, you can still get with, 5 to 10% down, depending on your debt to income and kind of other factors, right? But the triplex, quadplex, now for conventional, they're trying to tell you, hey, it's like 20% down. So it gets a little tricky, right? But you can still put down that 5% and go get a single family with the in-law suite, which is basically a duplex, or get a duplex and kind of make that work. And that's kind of, another way to make it grow.
Also, when it comes to, I believe it's just triplexes and fourplex. I'm sure Niyi can catch me on this. They have to pass a sustainability test, which basically means if you rent them out long term, this is just like on the numbers to make sure that that property qualifies for the loan. So you have your own personal qualification for the loan. Then they make sure the property qualifies for the loan. If it's a triplex or a fourplex, they basically take the rent of what they would get for long-term rental. Let's say it's $2,000 or it's $2,500 for a 4-unit. So it's $10,000. Yep. If I remember correctly, like I said, Niyi can catch me on this. The mortgage can't exceed 75% of that number. So if your mortgage is like $7,500, you can't get it. But anything below that, you should be able to, and that's a sustainability test in that regard. So whatever.
Right. I went through this.
Is that about right?
Yeah. So I think that is actually right. Yeah. That's spot on. So I went through this. We actually had to like play around with it was looking for a second. They were like, man, we can't do the loan. I'm like, what do you mean we can't? We're like 10 days away from closing.
So what we ended up having to do was we raised the purchase price up to the max appraisal, which was like, it was like 12K higher, 50 exact number. And then we maxed out the credits, right? And used it to buy down the interest rate from like a 6 something to like a 3 something, which lowered the monthly payment, which then met the sustainability report. So it was, we were definitely tweaking. I think we met it by a couple dollars, but hey, we closed and Desmond's doing fine. I said, we're good. All right. Yeah. They made it more difficult, but long story short, they're starting to change up the rules and add a lot more to it. So they're trying to cut out investors. We'll put it like that. But guys, we are at time.
All right, guys. See y'all.
Good night, y'all.
All right.